Greece's bailout programme expires at the end of this month, and the new Greek Prime Minister Alexis Tsipras has insisted he won't seek an extension. But without a new deal, European Central Bank funding for Greece's banks would dry up. Athens would be forced to impose capital controls and, in effect, suspend its membership of the Eurozone. So how did we get here? Here, in 5 charts, is Greece's crisis. How serious a problem is Greece for the Eurozone? Greece is on a scary collision course with its international creditors. 5 years ago, after admitting it had lied persistently about its public finances, the country had to be bailed out. But the new left-wing Syriza-left government wants to ditch fiscal austerity and unwind other reforms. If a deal is not struck soon, Grexit, Greece's exit from the Eurozone, could become a real possibility. Then the next question would be, which country will go next? How big is Greece's debt? Even after restructuring in 2012, Greece's government debt is still high. It's the Eurozone problem child. But 80% of Greek debt is owned by European institutions or the International Monetary Fund. Much of it is long-term loans at low interest rates. For Greece, the issue is more about shifting the balance of power in the Eurozone. After the humiliation since 2010, it wants to control its own destiny, and Syriza believes it can win a much better deal for ordinary Greeks. What are the immediate deadlines? Greece has to make some pretty hefty payments to its creditors soon, and the government is spending money fast. A 1.4 billion payment is due to the IMF in March, and big sums are due soon after on bonds owned by the ECB. But the real crunch moment could come even sooner. Greece's banks are relying on as much as 60 billion euros of emergency liquidity assistance. That emergency help requires ECB approval. And if Greece is not in a rescue programme, the ECB could pull the plug at any time, forcing the collapse of Greece's banking system. Greece refuses to ask even for a temporary extension of the existing programme, and its European creditors rule out a bridging loan. There have been no signs of real panic amongst ordinary bank customers yet, especially compared to the drop we saw in 2012, but the situation is fragile. What has been the market reaction? It's a hair-raising time to own Greek shares, especially in Greece's banks. The country's stock market has swung wildly as the prospects of a deal have risen and fallen. Crucially, the government can no longer borrow from global bond markets. Last July, Greece raised 1.5 billion euros in 3-year debt at an interest rate of just 3.5%. Now it would have to pay more than 20%, although that's still a lot less than its theoretical borrowing costs when its crisis first erupted. So, will we see Grexit? This is the big question, but one perhaps for games theory experts. Yanis Varoufakis, Greece's new finance minister, specialised in the subject when he was an academic economist. Spanish, Italian, Portuguese bond markets have hardly reacted. They seem convinced someone will blink, reckoning it's in everyone's interest to strike a deal. There's also the QE factor, the ECB is about to buy government bonds. But this is an exceptionally high-stakes game being played out in Europe's capitals, and there's always a risk of accidents.